So there you go.
Hi, this is Mike Swanson. I run the website WallStreetWindow.com. And today I'm speaking with a very special guest. I'm talking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Good, Mike. Thanks for having me.
Well, it's a wild day in the markets. It's been a couple down sessions led by steep drops in the Nasdaq. Stocks such as Apple got hit. Stocks such as Tesla really got pounded. Tesla was down 15% before the open today, which put a lot of pressure on other technology stocks. So what do you think is going on? Why is the stock market dropping like this?
I just think and I did a private video for my paying members on this like last week. And I showed a lot of charts. I'll show a few charts here on too in a bit. I just think it's a gigantic bubble. I just think that if you just ignore the noise, everything with COVID, the economy, all of this sort of thing. If we just look at the charts of the Microsofts, the Apples, the FANG stocks, you can throw Tesla in there, and some of these kind of like lesser tech names, which have benefited from COVID and everybody staying in, people have all piled into these names. I would say there's probably like 40 to 50 of these companies, and they're all the classic parabolic, straight up kind of blow off, similar to what we saw in gold and precious metals in 1980, the Nikkei in 89, the Nasdaq in 99, 2000. I think it's just a classic parabolic blow off bubble. It went way crazier and higher than I ever thought, but it just looks like everything got overextended to the upside, and it's kind of just now starting the air is kind of getting pricked out of that bubble. If you go look at the Warren Buffett indicator, which again, maybe I'll do that right now. Let me find it first before I share my screen. Excuse me. Let me find that.
Well, as
chart.
You do that, I'm going to make note that one thing about what you're saying is that the S&P 500 is a market cap weighted index. And a lot of people may not know this, but what it means is that the more Apple goes up, the more it makes up the S&P 500. And right now, Apple makes up 7% of that index, Microsoft 6%, Amazon 5%, Facebook 2.4%. But Amazon, Microsoft, Apple combined are roughly 17% of the entire S&P 500. So as people have bought those stocks, that alone has helped drive the S&P 500 up. It's helped also push the Nasdaq 100 up. This is why those indices have gone up more than the Dow. And this is also why so many people like these stocks, because they've done the best. The more something goes up, the more people want to buy it. And then it can end up going parabolic. We saw those stock splits announced a few weeks ago with Apple and Tesla that brought a lot of excitement into those stocks for about a week. And then they kind of lost momentum. And now we're in this situation now where, they're reversing. And some are pointing out, as you are in this chart, how there's evidence that the valuations got so stretched, it's insanity.
That's another point that should be made too, is on top of the whole market being overvalued in terms of this metric. If you take those like 6, 7 big tech stocks, they're like 50% of the index or something, right? And the last time that happened was back in 2000. It's even more extreme than 2000. Like, I think it's an all-time high that the top 6, 7 market cap stocks. Like, if you look at it, Microsoft has got, almost 2 billion market cap. Apple was north of 2 billion at the top. Amazon, I think, is 1.7 or something like that. So like no company in history had ever had $1 billion market cap till this year. And now you got these companies, north of or close to 2 billion. So that's another point to make. So this just shows us here. And in kind of the early 70s, when this late 60s, early 70s, when that secular bear market started, we went to about 80% of GDP. So this takes, the whole market cap of the stock market and divides it by the GDP, right? And you can see in 2000, which was this gigantic bubble, and went to 137%. And then it went again over 100% in 2007. And by the way, never been over 100% before those two bubbles. In the 20s and 29, I think it only went to around 90% at the top. And then you can see, it fell actually to below 60% at the bottom in 2009. And what's happened here is we're at an all-time high because the market, the Nasdaq's well at a new high. The S&P broke its spring high. And of course, the economy has had this huge shrinkage in the second quarter, probably rebounded a bit in the third quarter. But, the economy shrank by 10%, 30% annualized, or nearly 40%, or I think 32% annualized, so 8%. So, but 8% overall. So the economy's down 8% from the top, but the market's at new highs. And now we have this more stretched than ever. Now you can argue this could maybe be at a higher valuation historically because interest rates are zero. So there's like there's kind of nowhere to go but in the stocks with interest rates being zero. But still, this is an extreme kind of indicator. And the median is, see this 70% level here? That's about the historical median, which means, let's say the economy was just flat for 2 years, the market would have to drop 50% or more just to get back to the historical median. And then, of course, there's been a lot of these stocks that we're talking about that have driven this gain. And what's interesting about this is this isn't the S&P 500. This is the Wilshire 5000, which is basically every stock in the United States. I don't think there are even 5,000 stocks listed anymore. So this is basically everything. And you can kind of see, where this has gone right now. And it's just, we're just totally overvalued from a historical, and this actually one even goes back even further to the 50s. And you can see back in the early 50s when that bull market started to 1966, it was like a third of the economy. Same thing in 1982. And we've just gone to some, and there's that 60s, there's that 60s peak I was talking about. And we've just gone to these extreme kind of scenarios. Now, this is earlier in the year. You can see where this one was right in 2000. So we're now above these highs of 2000 if it was done, there you see it there. Yeah. On the more updated chart. So I don't know where this is going to end, but it probably won't end well. I think the only way you could continue to go higher is if you probably had some form of hyperinflation, which even if we do have high inflation, I really don't see that happening still for another year or two, because that printed money that filters through the system usually takes a few years. Like the Weimar Republic didn't really see hyperinflation to 2 or 3 years till after the money printing. And I don't think we're going to see that kind of hyperinflation. I think we're going to see hyperinflation where they probably won't report it being like that, but it'll probably be in the double digits, maybe even 20% a year. And what will happen is these equities, what may happen is the market may, after an initial bear market, just do nothing. But with inflation going up 20% a year, it's losing value in real terms.
Well, right now, I mean, who knows what will happen by the close, but many stocks are off the lows of the day. I think the averages basically hit their 50-day moving average. So hopefully we can bounce. And if we can hold here, well, it's trying to bounce. I mean, it's still down pretty good, but hopefully it can bounce off that 50-day moving average. But the thing is, the way so many of these stocks have dropped, like Tesla and Apple, and then these valuations you've shown, that tells me that there's not great upside as far as like this being a great buy point if you want to try to hold it. Maybe people out there got a day trading program or something, but as far as buying, like I'm going to buy now to try to play a rally into the end of the year, I think you're better off buying other things. All that said, though, what would you make of this argument? Okay, let's say the market topped, but maybe let's say, well, if the Fed prints more money and does things, buys more bonds, maybe they can prevent the market from falling like it did in March. And, maybe you can't, there's not a lot of downside. So maybe this is okay. Maybe, that guy, Jerome Powell, he seems like a friend to stock market bulls. He really does.
Well, first of all, in terms of the short term, you can kind of see these handles going on here on the VIX. And, the basically intraday, each of the last 3 trading days, we've been over 35. So yeah, I think we're due for a bounce. I'm going to actually short the bounce a little bit via some put options. But I think, yeah, we're probably due for this kind of bounce here. And this is stock I do have some puts on. And if you look at Microsoft here, like Microsoft kind of has a support level.
Oh, it's below the 50-day moving average.
Oh, no. But it does have some support around 200. So maybe we'll bounce back a bit. But here's what's so insane. Like, I bought these puts probably in July sometime when Microsoft was about 210, 215. So the stock goes to 230. My puts are down, whatever. I used to using them as a hedge, right? Yeah. So they go down like 2/3, 60, 70%, right? And then whatever. And now I checked the other day, and now I'm up 50%. So it's just like, that's the crazy thing about, I have some January 160s, right? So I bought some out of the money puts on it. So that's the crazy thing about playing that. But I just think, yeah, you go look at the RSI now. Microsoft is 42, is getting oversold. So yeah, you're right. I think that these things can bounce here. And in terms of Powell and the Fed, I don't think they'll really react again, because they really haven't done anything since that. And they did a lot. So don't get me wrong. During that bust in the spring, I think they won't react until after the fact. If you get a 15, 20, 25% drop in the S&P or the market as a whole, and then I think they'll drop. Now, what I want to show you, though, let's actually go back to Microsoft. This is what worries me so much. When that's a shorter term chart, but I'm going to go back like 20 years on Microsoft, right? Actually, a little more than 20 years. So you can also see the blow off in 19. You see that right there, but that's a log scale. So I'm going to put a linear scale where you can really see these parabolic moves. So that was parabolic back then. Now it looks like nothing, right? But look at this. Where the hell is the upside? In a chart like this. Like, this is classic. Like this is a classic bubble. This is like the classic. If you go what gold looked like in 1980, or said the Nikkei in 89, you get a 20-year chart back then. And like Apple's the same way. Oh, sorry. I did the wrong ticker. I'll go back. It's okay. Sorry, I did a typo. Anyhow, yeah. So we go look at Apple. Like, look at that. That's the same way.
4%.
Yeah, the Apple's actually probably the stock I really want to buy puts on and any bounce, because again, look at the upside there. It looks very limited to me. It had probably the most parabolic move of all the majors, and and because it is so widely owned, and historically the last couple decades, it hasn't been that volatile. The premiums on it aren't crazy. They're higher, but they're not like totally crazy. And if we go look at Tesla, this is kind of the poster boy for insanity. Tesla hasn't been around for 20 years, but you can see, that what's gone on there. And of course, Tesla has a higher market cap. I think if you take Volkswagen out, which is the largest automaker in the world, or no, so it's Toyota. You combine every other automaker in the world combined out and don't include Toyota. Tesla has a higher market cap than all of them put together. So, or had, at its top. That is how like insane that it's kind of gone. So it's just, these stocks have gone like, totally insane. And the thing that's crazy too is that I just showed you Microsoft and Apple. Those stocks really don't have any growth right now. Those stocks, if you look at the revenues, haven't moved anywhere for a couple of years, yet those stock charts have done that. And I'll show you Google or Alphabet or whatever they call it now. And that's not quite as crazy in parallel, but still pretty crazy, went to over $1,700, IPO'd at 100 back in 2004, So, yeah, it's just a question. And then look at, there's other stocks too. Like, this is Moody's. This is a stock that we have a small short position in too. And you can see that it's just a company that, does ratings for debt. And look at that thing, that gone completely parabolic too.
Well, I think, when the market does have pullbacks, it does create an opportunity to buy things, but the things to buy are the things doing better than the market. So for instance, Apple being down 4%, is not performing better than the S&P 500. It's performing worse. But one stock inside the S&P 500 that is doing very well, and I own it, is Barrick Gold. It's up 2% today. While Apple is down 4%, Barrick Gold is up 2%. And it's a stock that Warren Buffett bought himself several months ago. It's one of the few stocks he's bought all year. The symbol's G.
I got the Canadian symbol, so
okay.
that's fine. Okay.
But the thing about Barrick Gold, it's doing well because the price of gold is going up. So its earnings are actually growing, whereas most companies' earnings are shrinking. And this is happening across the mining sector. Just on September the 1st, in fact, Hecla Mining announced that it was boosting its dividend by 50%. It's boosting its dividend like 50%, while many major American companies are slashing their dividend to zero, such as Disney has slashed its dividend to zero, while Hecla's done it to increase by 50%. And Hecla's got a chart where it's not straight up like the others that are in Barrick too.
And the thing is, look at these charts.
So
Look at these.
better buying for me. Look, Hecla's up a penny today. Well, a penny might not sound like much, but it's up. It's better to be up a penny than to be down 4%.
Yeah, and I actually own a little Coeur d'Alene, and yeah, you can see that's up 5 cents today. And again, look at that chart, right?
Yeah.
Compared to now, Coeur d'Alene's a pretty poorly run company. Don't get me wrong. So I don't know if it's going back to 70, but this thing can still go back to the highs of 2011, $30 a share or something.
Yeah, sure.
So it just shows you, like, again, yeah, you look at those stocks. None of those stocks are above even though gold's above the 2011 highs. None of those stocks are, and they're not parabolic. They're not. Short term, sure. Can they consolidate? Why not, right? But we can just see that's the difference. The gold and precious metal stocks are cheap, and those tech stocks and all these other things are blowing up. And talk about the market. We talk about, okay, what happens if Powell does something? So what happens if all of a sudden, remember, the gold stocks have done this with this huge run in the stock market, right? What happens if the S&P goes down to 2,500 or something, and the Fed decides that there's two things that comes in. Number one, I think a lot of people will start losing their ass in those big tech stocks, and they'll go into gold stocks because it might be the only game in town. And probably gold will start going up in anticipation of the Fed doing more. And then gold will go even more crazy because the Fed will start doing more. They might even buy ETFs. Who knows? They've done it in Japan. We've seen them buy corporate bonds. So I could see them buying equity ETFs. And then the Fed does that, and gold stocks will go even crazier at this point, Yeah,
that's why I've got money in them. It's an exciting time for them for sure. They've been beating the market all year, and so is gold and silver. Gold only pulled back like 10% in March when the S&P 500 fell 30%. So it's, in my view, less volatile than the stock market and a safer investment.
Yeah, and like you said, like
couple years.
I think it's interesting right now. Like the gold stocks have come off a bit, but like you're saying, like today the market is down, and the gold stocks are up 1%, right? And really look at this. You look at this market decline. Gold stocks actually started correcting before the market, and really this just looks like a little consolidation. This just looks like we broke out. Similar to what happened in say June or July, right? We broke out, and now we're just kind of sitting here and maybe getting ready for the next move higher.
Sure.
So, and I think that's the catalyst, that if there is a decline in the stock market, and if the bubble starts bursting in those big stocks, which now make up a huge part of the index, I think the Fed will come in and do something more to prop that up, and gold stocks benefit even more from that,
Sure. Well, it's definitely been an interesting couple of weeks. It'll be interesting to see how the rest of this month unfolds. I don't have anything more to add today. So if you got any last thoughts, or at least tell people.
No, I just think that what we're saying, it's going to go back to the regular screen. Yeah. I just think that what we're showing from those charts is we have this parabolic, and I'm telling you, I can't tell people those moves don't happen. Let me do one more thing here. I'll get the neat guy. 1 second. Let me do it well. Yeah, those moves just don't happen very often, right? Like I'm going to put up the Nikkei, you know, going back in to 1990. One second. I'll do this in a second. You got the Nikkei right here. I'm going to show you the Nikkei. What I'll do is I'm going to go all the way back to 1980 in these charts. So I'll show you the Nikkei move, and then I'll also show you the Nasdaq. What I'm going to do is actually end this chart in the early 2000s, so you can just see on both sides. There it is. So yeah, this is the Nikkei here. So look how similar that looks to all those tech stocks I just showed you, right? But you know, in 1982, the Nikkei was 7,500, and then it was almost 40,000 at the top in 1990, and you know, in 2003 it was 9,200. Now I don't know if we're gonna have a 13-year bear market, but you know, this is what happens after you get these parabolic moves. And then because I've got the 90s here, we're gonna go look at the Nasdaq 100. And look at that. Again, look how similar that, again, that looks to the Microsoft, Apple charts, all those things I've shown you. And again, look what happened after that blow off. We saw the market go down. The Nasdaq 100 went from 4,700 to almost 700, right? So this is what happens after these parabolic moves. Now, maybe the Fed will come in earlier. Maybe they'll print money. Maybe they'll prop it up a bit more. I don't know. But I could definitely see a 50, 60, 70% down move in a lot of those big tech names. And now if you want to go out, now look how crazy that Nasdaq chart looks then, right? And then, and look how crazy it looks now. You know? So it's just like,
that is wild.
That is totally wild, right? So, and actually George Soros himself, they asked him about the markets. Forget what you think of his political views, because he is one of the greatest speculators ever. When they asked him about it, he just said this was a Fed-induced Fed-induced liquidity bubble, and he wasn't in the market at all, right? So, and Leon Cooperman is kind of like, you know, he's been very bullish over the years. He says it's a bubble too. So you have these big names saying that this is a bubble as well. And I just tell you, I just know that, again, unless you go into hyperinflation, this kind of move, you're talking probably ultimately 4,000 on the Nasdaq, you know, in the bust or something, you know, like, you know, something in that realm minimum, you know. So I hate to burst people's bubble, but the bubble probably will be burst at some point, you know. And by the way, this is why on any little bounce here, I have no problem doing some small short positions, because you put it in perspective. Okay, maybe the market, the Nasdaq has smashed down 1,000 points, and the Nasdaq 100 has, but look where it is historically, you know.
Wow. Well, it's going to be interesting. And, you know, the outlook for gold and silver is just getting more and more positive, I think. And I think this week shows it.
Yeah, I think, like, just to finish off there, I think that's the major point we have to make here, is that gold and silver have had this huge move with the market going higher. Well, if they become like a safety play or flight to quality play and the market's busting, then it's like all that money that's rushed into the stock market is going to rush in gold and silver with nothing else, you know. So,
well, thanks for talking with me and everyone else out there in the YouTube world, and we'll talk again soon.
Yeah. Thanks for having. Thanks for being here.